Have you ever considered the pros and cons of dividend investing when it comes to retirement strategies? When we think about not drawing down the savings account, actually being able to generate enough income through dividends to supplement Social Security, it might be a really good fact. But in today's video, we're going to be looking at the pros and cons of this. Now, when we start thinking about retirement, there's a lot of different rules, and a lot of the rules are very, very outdated. We see the 4% rule that Dave Ramsey talks about, the multiply by 25 rule, even the rule of 100, which states when you start looking at 100 years, or 100 essentially the number, minus your age, that should be your allocation when it comes to the amount of stocks you hold. But this is a theory, or really a logic, that came around about 50 years ago. It doesn't seem to be very prevalent today, and the rules have completely changed when it comes to retirement and when it comes to retirement investing. So for instance, in this, let's say I'm 50 years old, rule of 100 says I should have only a 50% allocation into stocks at that point in my life at the age of 50, which doesn't make sense. There's been a lot of studies, 2003, 2004, even coming into 2005, that said if a majority of retirees were still invested in the market itself versus going into safer CDs, bonds, things of that nature, they would have seen enough growth through retirement that they would not have run out of funds when it came to the retirement. So what exactly is a dividend stock? Now, a dividend stock is a company that pays its investors or its holders of that share based on the profitability of the company. Now, when it comes to profitability, companies have two options. One, they can reinvest all those dividends or the money that they earn back into the company itself. Or the second one, they can pay a dividend to an individual that owns the stock itself. So what are some of the pros and cons? Let's break these down one by one. So pro, dividend stock can be a great source of retirement income. When we start thinking of stocks in general, there are some that pay an incredibly high dividend. We are looking at 4, 5, 6, 7, 10%. But of course, once you start getting into those higher dividends, the risk for them is much higher, but also looking on kind of the flip side, that is money they are not reinvesting into the company. Now, another pro, income from dividends is flexible. Think about this for a minute, where if you own a company and you are pulling the dividend out every time it is paid, you have the option of taking the dividend as a payment. You also do have an option of reinvesting those dividends depending on where your monthly cash flow is, exactly how much you do need to put in. This could bulk up the emergency fund. This could cover an unexpected expense. And this really makes a big difference, again, when people are trying to supplement Social Security. So dividend stocks as well are usually value stocks. When we think of the companies that really have paid dividends for an incredible amount of time, we know Warren Buffett's favorite, Coca-Cola. When you start looking at Johnson & Johnson, you look at Hormel, Lowe's, Home Depot, Black & Decker, there are a lot of companies that have paid dividends, and some of them, like Coca-Cola, for north of 100 years they have paid dividends. That is the reason why a lot of people do that. Now, when we start thinking of the value stocks, these are the blue chip companies. These are not the tech stocks. These are not stocks that are going to shoot up through the moon. They are going to be your constant and really consistent churners of paying dividends while still being profitable and being really in the green for a majority of time. Now, when we start thinking of the cons, dividend stocks are usually more expensive than other investment companies. This is because a lot of people are into dividend income and dividend investing. When we look at YouTube, when we look at social media, dividend investing is absolutely crazy. It seems like over the past probably 20 or 30 years, it has absolutely caught fire, and a lot of people are buying and holding these big, large dividend companies like Coca-Cola because they are very consistent. Now, another pro, income as well as an asset growth. This is really investing one time. You're profiting from it twice. So not only are you buying a stock or buying an asset, when you invest in that asset, it is going to grow in value, and it can also generate income that can be really compounded in there, or you can choose to take those dividends. But you can see where it is kind of the double profit. If I buy, for instance, Coca-Cola at $200, I'm getting a dividend on a regular basis. If the value of Coca-Cola goes from $200 to $250, I made $50 per share that I hold of Coca-Cola, and I'm getting, again, the profitability twice because I'm getting paid out with those dividends. Now, when we think of this, they can also help you hedge inflation. This is another part where if you are sitting on a savings account, if you are sitting on that emergency fund, if it is parked into a regular institution, not a high yield saving, not something that is probably giving you 3 to 4% return, dividend stocks can really hedge inflation if they're yielding, and if they're beating out right now, I believe we're around 2.8%. So if you're getting 3% or better, you're really beating out inflation and you're not losing money. Now, one of the cons for this, individual stocks. Me personally, I do not invest in individual stocks. I feel like even though they're value stocks, there are a lot of things in companies, especially when we start thinking of global tariffs, that can drive the blue chip stocks down because they are the consumer staple items. They are the well-established companies that are global companies. When you think of Coca-Cola, they are pretty much in every country in the world. And I know having, I believe at this point, hundreds of different flavors of Coca-Cola itself. So they are really invested. But again, when it comes to tariffs, this could impact the profitability from importing and exporting. Now, another con of this, you have to choose your dividend investments carefully, exactly knowing which stocks are going to anticipate dividends, how often they are being paid. You don't want to put a ton of money or lump sum invest in here, knowing exactly what the value is going to be. And again, I really do caution everyone when it comes to individualized stocks. It is incredibly hard to select a stock that is going to be very profitable. Now, another con in here, dividend stocks are usually utilities, banks, old line industry, or really those staple consumer items like Johnson & Johnson and Coca-Cola. They can produce a lot of cash income, but again, it's going to be pretty narrow in the sector that you're investing in. And I know banks traditionally have been incredibly well and do incredibly well when it comes to those regular payouts. Now, pro with this one, you can get diversification with mutual funds or ETFs. Now, for me, ETFs are the absolute way to go. When you start thinking of Vanguard, Charles Schwab, BlackRock, they have a lot of high dividend ETF portfolios that have either a broad focus or they have a high dividend yield like the S&P 500. Instead of investing in one company, this is an absolute pro. Where we look at dividend yields on average with these funds are around 3%. They can be as high as 9 to 10%, which is incredibly lucrative. Now, another con we have in here, stocks are generally riskier than bonds and other fixed assets. So when we start thinking of stocks versus bonds, this is the reason why even with the S&P 500, we see about a 10% growth. With bonds, we see about a 2 or 3% growth. If you think about that for a minute, if you look at something like the BND, which has had about 2.4, 2.6% growth over the last 10 years, it is not beating out inflation. If you're parking money in bonds, unfortunately, you're going to be losing money because the inflation, the consumer price index, everything else that's going on in the economy over the last decade has been eating up a lot of those gains and really going through there. Now, another con for this, allocations can be very tough to figure out depending on your portfolio. How do you hedge against market volatility? Unfortunately, really depends on your risk tolerance. If you're looking to take high risk, if you're looking to really mitigate some of this. And of course, another big pro in here is looking at dividends can have a big tax advantage. Depending where the IRS classifies either income or capital gains, the capital gains tax is much lower than your income. Depending on how much money you make, it can have a huge impact. If you're in a bracket paying 37%, more than a third to Uncle Sam of your portfolio, if you're getting those dividend incomes and they're treated as capital gains, chances are you could go ahead and you could make a lot more money or have some tax advantage accounts when you're taking money out when it comes to dividends. Now, of course, before we do this, consult your tax advisor. It is super important. Now, one thing a lot of people don't realize with this is the double taxation. A lot of experts criticize the way that dividends works, really dividend producing stocks work, because they're taxed at a corporate level, they're also taxed at a personal level. So it is a form of double taxation that the government does kind of double dip in there, and it can also hurt the company if they're paying out too many dividends. There's been a lot of dividend yields that we've seen that have been super detrimental to a company, or even paying out more dividends than they actually earned, which of course is just going to take that company. And the final one we're going to leave with, dividend policies can change over time. When it comes to companies, dividends are never guaranteed. When it comes to a company and the profitability of the company, the first thing they're going to be looking to cut if they are in financial hardship is going to be dividends in the entirety. That is the first thing that is going to be completely gone. So, guys, so that's going to do it for today's video. Let me know in the comments what you guys think, and as always, thank you guys for watching.